Thank you for joining me. I'm Alex, and I would like to talk to you about Apple today because I had planned to make a video about Target, but Target went up 20% today, and I would like for things to settle down before I do a thorough analysis to not have these inflated prices or maybe the new baseline or. So it's hard to gauge whether or not it stays up there, goes up further, goes down. Very hard to say. So we're doing Apple today, and you might know what they do. They make everything. So Apple went up 1% today, pretty much the same as the market. And as a company as huge as Apple, you would think that they're sticking pretty close to the market without any major news coming out. So the price is $212 right now, which is a pretty good price. I remember them being $270 when I looked at stock prices in 2001, and surprisingly, I didn't buy. So the PE is over 18, under 20, which is not too bad, especially with a company, I wouldn't say as safe as Apple, but Apple is pretty safe. They have grown significantly since they came out with the iPhone, and despite all the challengers that have come since then, and their international market share in the smartphone business is about 20%, but they have consistently stayed up there. They have consistently had high-end phones that were the flagship, kind of. So like most celebrities and stuff would go with an Apple phone instead of, getting a Pixel or getting the new Samsung flagship or whatever else. So the brand recognition is definitely there, which has helped them a lot. Dividend yield of 1.5%-ish is all right. It's not great. It's not terrible. It definitely helps a little bit. So I would think that with a company as safe as Apple, with a PE of under 20 and a dividend, it's even that alone just speaks definitely not a terrible investment. So payout ratio extremely low. So they could triple their dividend yield to 4.5% and still only pay out 75%. They won't, obviously. They could, though. So would be helpful if you're holding Apple stock at that point. Now, they have in the past favored stock buybacks over increasing their dividend, but that also helps you in the long term if you're already holding Apple stock. So it's kind of a wash there. Revenue growth of 15% last year, but before that, it's down from 3 years ago. So they had a significant downturn in revenue and then a slight growth. So over the last year, 15% is pretty good, but with it being so inconsistent, I wouldn't rely on that. I definitely don't see them growing that much this year. I do see them growing significantly next year because some people at the very least will be waiting for 5G to get their next smartphone. So I don't really see a huge growth year this year. And next year, we'll see what the economy does until then. And Apple has definitely been hit by the China tariffs. So definitely a risk factor there. And we'll see how the tariff situation plays out. But earnings growth even better than the revenue growth, but the same inconsistent results. They're obviously with a huge revenue they have, a dip in revenue tends to lead to a dip in earnings. So same picture there. It went down significantly, and then it went up small, and then it went up pretty big. 20% is amazing for a company that big. Total assets $365 billion is obviously amazing, and the total liabilities of only $260 billion is also pretty nice. So net tangible assets of $106 billion. Balance sheet looks amazing, and everyone knows that about Apple. They just have billions and billions of money laying around, you know, nothing to do with it. They started doing the stock buybacks. They could increase the dividend. They could increase the stock buybacks. There's a lot of things they could do. They're obviously also spending a lot in R&D again, coming out with new MacBook Pros and all kinds of stuff, Mac Pros. To summarize that, PE of under 20 with a dividend. So for a value investor, that looks pretty good, and you should definitely look into Apple. For a dividend investor, the 1.5%-ish seems pretty low, and with a lot of shares outstanding, their share buybacks also don't affect that too much. So I would think that for a dividend investor, the yield is pretty low, so I would probably go with something else, especially when a lot of higher yield dividend stocks are so cheap right now. For a growth investor, I would also probably stay away from this because the growth is inconsistent, and 15% is also not that great, even if it were consistent. If that were consistent over the last 4 years, I would definitely recommend it to a growth investor, but it's not, and I wouldn't. But you should probably always be investing for a value dividend mix kind of thing. So definitely something to look into, definitely something that could build a good, fairly safe baseline for a portfolio. So I would recommend looking into that if you're a value investor, and maybe make that one of the bigger positions, because it seems like they're a fairly future-proof company. It seems like they can weather even downturns in the market very well. They have too much cash laying around to really be affected by a recession. So for those reasons, I think it's one of the safer stocks out there that could be a good base for pretty much any portfolio out there. So with that said, if you haven't already, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.